The world of investing occasionally bleeds into our everyday conversations or pop culture, but do you actually know what these 10 investing terms mean? My name is Isaac and welcome to Market 101, where we give you the basics on finance, economics, and of course, the market. Today I'm going to be defining 10 investing terms that you should know, and I want you to comment below what are 10 finance terms that you want to learn more about. Maybe some are in this video, maybe they're not. But let's dive in with number 1, investing. I know this seems a bit obvious, but a lot of people get investing confused with stock trading. Investing in the most general sense is allocating money to something of value, whether it's a company, real estate, a material item, with the goal of the investment rising in value over time and generating either a profit or a gain. Stock trading, on the other hand, is the act of buying and selling shares of a publicly traded company on an exchange. By doing so, you're creating an investment. If you're going to start investing, you're going to need to build a portfolio. A financial portfolio is a collection of investment assets such as stocks, bonds, CDs, cash, commodities, real estate, private investments, and many more. You may manage your portfolio yourself, or you may choose to have a financial professional manage it for you. What your financial portfolio consists of should be tailored to suit your personal financial situation and goals. Market capitalization is a tool investors use to determine the size of a company in the stock market and then compare the company's financial performance to companies of the same size. It represents the total dollar value of a company's outstanding shares of stock in the market. To calculate the market cap, multiply the number of outstanding shares times the current market value of one share. If the total is between 250 million and 2 billion, it's small cap. Between 2 and 10 billion, it's mid cap. 10 billion and 200 billion is considered large cap, and mega cap is anything over 200 billion in market capitalization. In the finance world, people reference indexes or indices all the time. Indexes and indices are the plural for the same word, index. Some people prefer to say one or the other, but both are technically correct. I prefer indexes. A market index is a hypothetical portfolio representing a segment of the financial market. It is important to note that investors can't invest directly in an index. These portfolios are representative, meant to give us a picture of what the market is doing. The Russell 2000, for example, focuses its attention on 2,000 of U.S. small cap companies. The S&P 500 is 500 of the largest companies listed on stock exchanges in the U.S. There are other indices which measure the economy, such as the Consumer Price Index, which looks at the prices of goods and services across the country to measure inflation. There's also the ISM, which is the Institute for Supply Management. It's known as a Purchasing Managers Index. It is the monthly indicator of U.S. economic activity based on a survey of purchasing managers at more than 300 manufacturing firms. Indices are a great tool for data, and they're especially useful when it comes to viewing the stock market. If you own stocks, you may receive dividends. They are a product of value stocks. A dividend is a percentage of a company's earnings distributed to its shareholders. The amount of the dividend is determined by the company's board of directors. You will often see it expressed as a percentage of the company's share price. When it comes to the stock market, you may have heard people classify certain stocks as growth or value. If a company's stock is classified as growth, it means that stock is expected to grow at a faster rate than that of average market growth. These stocks also primarily do not pay dividends. This is because the company will reinvest any earnings instead of paying them out to the investors in order to accelerate their short-term growth. Investors can expect to earn profits from the capital gains of the stock when they eventually sell their shares. On the opposite hand, if a company's stock is classified as value, that means it is trading at a lower price than what the company's financials and performance indicates it should be. Value stocks are associated to businesses with strong financials, consistent operations, and a well-established position in the market. These stocks typically issue dividends since the company has less need for capital. And hey, if you're liking this video so far, smack that like button. It helps us know if we're on the right track with making these videos. An ETF is an exchange-traded fund. It gets registered and approved by the SEC, and the fund becomes an investment company. This little investment company buys and holds the assets outlined in its filing and sells a portion of itself to investors. For every $1 you buy in an ETF, you own $1 worth of the securities representing all the companies in that ETF, instead of buying individual stocks for each individual company. ETFs can be centered on a specific commodity or a specific strategy. The first ETF was the SPDR S&P 500, which tracks the S&P 500 index and remains popular with investors today. ETFs are popular because there's a lot of options and tend to be reasonably priced. You can get as broad or specific as you want. bonds are simply defined as certificates of debt. You wouldn't normally think buying debt is a good idea, and yet it can be a healthy part of a portfolio. Here's how they work. A bond is a way for the government or a company to borrow money from consumers. If they need to generate capital, they sell certificates of their debt, aka bonds, to investors. The investor will buy the bond, lending the company money, and at the bond's maturity date, the company will pay back the purchase price plus interest. So essentially, this is a loan where you are acting as the bank and the company is acting as the borrower. It might seem simple, but bonds are a little more complex than that. If you want to learn more about bonds and how they work, we have a second channel called Market Minute. Market Minutes are YouTube shorts designed to give you stock market and financial definitions. Linked below are 2 videos explaining bonds. Have you ever seen the iconic bull statue on Wall Street and wondered, what does a bull have to do with the stock market? It turns out animals are a great illustration for financial concepts. When you hear bull market in the news, this means that the market has increased for an extended period of time and gained 20% or more in value. The opposite is true for a bear market, which means that stocks have fallen 20% or more for a prolonged period. Likewise, if someone is feeling bullish, that means they're very confident and optimistic about the market. And if someone is bearish, that means the opposite, more reserved and skeptical. A good way to remember which term means rising or falling is to think about how the animals attack. A bull thrusts its horns upward to attack, while the bear swipes downwards with its paws. So bull equals upwards motion and bear equals downwards motion. Many factors play into what causes a bull market, such as strengthening economy, and there's also the human element, the psychological factors of how investors are feeling. Are they feeling bullish, spurring a bull market, or bearish, possibly spurring a bear market? Many people try to time the market when investing, meaning buy low, sell high. It sounds easy, but it's a lot harder than you would think. Most people come up short when they try to use this method. Dollar cost averaging is a strategy that makes it easier to deal with market volatility by making investing systematic. This also is a good tool to help form the habit of investing regularly. A good example of dollar cost averaging is 401k plans. You allocate a certain percentage or dollar amount to be contributed to your investment account each pay period. No matter if the market is up or down, you're still purchasing the same dollar amount of shares. The difference is how many units of shares your dollars are buying. If the market is up, you're buying fewer shares. If the market is down, you're buying more shares. This allows you to take advantage of highs and lows of the market without trying to time it. And those are the top 10 investing terms you need to know. But there's probably more, which is why we're here. Subscribe so you can learn more with every upload.